Budgeting for Manager students. This is a very brief example in a Google spreadsheet of a capital budgeting problem. And I don't know if you remember back when we did the contribution margin income statement for our friend John, who was going to open a canoe shop. One of the things that we could have proposed, since his numbers were marginal at best, is that we could propose that he goes into the rental business. And so this is a very minor proposal for purchasing 5 canoes and then renting them out, um, in theory, for Saturday and Sunday for the 10 weekends in summer. So it's a fairly modest in terms of its objectives or goals. And this is kind of the typical setup of a capital budgeting problem. But let me talk about capital budgeting in general before we get into the problem. So capital budgeting is used when we want to invest in a project or make an investment in equipment or something business related, and the investment is going to be in the present, or what I'll refer to as time zero, and the cash inflows or the benefits are going to be spread over multiple years, maybe a few years, 3 to 5 years, or it could be many years. It could be an investment in, say, manufacturing equipment that's going to have a 20-year life. And one of the things that we try to do is we try to look at those investments and make those decisions as rationally as possible. And the way we do that is we try to organize and understand the cash outflows in time zero, and that may come from your budgeting project or process, or from just a purchase proposal or something of that nature. And then we try to predict the cash inflows over time. And then once we have those cash inflows over time, we discount those cash flows to bring them back into the present so that we can compare them, the inflows to the outflows, to see if it's a desirable project. In this case, we're using a net present value model. There are other models, accounting rates of return models, internal rates of return models. I personally think that the net present value model is probably the best model. It leaves less to chance and gives you what I would call the firmest overall grasp of the project. So take a look here just at the simple part of it to begin with. Um, we're going to rent these canoes for 20 days, but because there's 5 of them, that's 100 rental days. And if we're talking $25 a day, then that returns $2,500 each year that we rent those canoes out. And then at the end of the 3rd year, we're assuming that the canoes are going to be pretty worn from the use, and so we're going to sell and dispose of those. And if we like the project, we might repeat it at that point with a new acquisition. Now, if you just look at this very simply without any sort of other detailed analysis, you might go 2,500 times 3, that's 7,500, and then 1,500 coming to us on the back side, that's 9,000 in, and we're spending $6,220. So you might go, would I trade $6,290 or $6,220 for $9,000 over time? And you might, at first glance, think that that's a pretty good deal, or that you might be willing to do that. And we're going to show that that's not really quite as lucrative as you might think it would be. The first sort of fly in the ointment is the fact that there's a storage cost here. And so this $1,200 to store the canoes. Now, you may be able to find free storage in your backyard or your neighbor's garage or something like that. But in this case, they've kind of figured that, okay, this is what it's going to cost to rent a storage unit, or however we're going to deal with this, and it's going to be $1,200. So that reduces our annual cash inflow to $1,300, each year. And I guess the point of this one expense here, and of course you'll likely have many expenses, is that cash flows that are in the same period can be netted against each other. So since I'm going to receive $2,500 in year one, I can subtract the $1,200 in year one, and my net cash flow for the year is a $1,300 inflow. So now you can see I've got the 1,300 in each of the 3 years, and the 1,500 coming in the 3rd year also. which starts to make the project less attractive. Um, so then what I'm going to do is I'm going to discount each year's cash flows to the present to get the present value. So in year one, I'm going to discount the $1,300, which is presumably going to come in, at the end of the year after I've done the initial investment in time zero. And so that makes that $1,300 coming in at the end of the year only worth $1,131 and some change. And then I'm going to discount the second year's cash flows, which is going to make them worth less, which is only $984. And I'm going to discount the third year's cash flow, which, since they'll be discounted 3 times or for 3 years, only makes them worth $857. And then I'm going to discount the $1,500 from the sale of the canoes at the end of year 3, and that's going to be only worth $988. And when I sum up all of those discounted cash flows, you can see that the project returns on a discounted cash flow basis $3,961.97. And so this represents a project that we would reject because the present value of the stream of the cash flows is less than the initial outflows in time zero of 6,220. Now, a couple of things about the setup on these. I generally like to think of them as flowing from left to right. We write from left to right. Lots of times when we're organizing financial statements, we organize them left to right. And so I think of my time series as chronological, moving from left to right. And then I try to set it up with the initial expenses sort of in time zero, kind of clear and identified for me so that I understand what's going on. And then I think about making the cash inflows sort of look something like an income statement, something with the inflows, and then subtracting whatever outflows that I can identify that appear in the same time period as the inflows to get to some kind of a subtotal, and then I discount those cash flows to sort of understand the project. You'll see these organized some ways vertically, or alternative setups. Those alternative setups, they work, and you may be comfortable with them. I've just never been comfortable with them. I kind of a creature of habit. I like them to work the same way that they've always worked. So one of the things, once you have this set up, is you can start to play with what-if analysis. So I'm going to change the rental price, if I can do this without messing things up, to $40, which is probably a little more realistic, with inflation and the passage of time. You're not going to be able to rent a canoe for $25 a day anymore. So I'm going to go with 40. And you can see, because I've got my spreadsheet set up nicely, that now this project becomes a favorable or a possibly doable project, because I've increased my rental income quite substantially. My storage income, I didn't increase in this case. If my storage income was subject to inflation, I probably would need to adjust that number also. But now you can see the cash flows are larger, and my total cash flows at the end of the project, all properly discounted, come in at $73.92.50, which is more than the outflows. And so this is indeed a project that produces profit for me over time. And so this is a brief look at how a capital budgeting model might look. There's kind of both a lot of skill and a bit of art to doing these, in terms of, the art being getting the projections all right, making all of the correct assumptions, getting the correct discount rate, and then there's the skill of sort of setting up the spreadsheet and making it all happen. This is a very useful tool to have in your thinking, because lots of times most of the business choices we make, and quite honestly, most of the life choices we make don't achieve immediate gratification. They have long-term payoffs, and we need a tool to evaluate our long-term benefits against our short-term costs. And so capital budgeting is that tool. So I encourage you to review the homework and to work with this tool. You will have a memo that's due where you have to do a little project with this. They're not very complicated projects, but they're of a similar nature to this example here. So I wish you well with that process. Thanks for listening. Take care.